As we come towards the last part of this particular unit, we are now going to cover a few more things like how do we analyze the income statements. We are going to explain a term called common size income statements. So we're going to look at what do we mean by common size income statements, and then comprehensive income statements, or a term called other comprehensive income. Right, that's not too relevant from our perspective under Indian companies, but nevertheless we should understand what the term means, so we're going to try and talk about that term as we go along. Right now, the first thing we need to understand is that when we look at multiple companies income statements, right, so when we are comparing income statements, unless we use some sort of ratios, we can't really compare income statements between two companies. I mean, there's a company that makes revenue of 200 crore and there's a company that makes revenue of 20,000 crore. Cost here is 150, cost here is 13,000 crore. Unless we really dig deeper into the numbers, we can't compare these two companies because their size and scale are completely different. So we have to get them to a common metric where we can try and compare as to how the numbers look like for these two companies, assuming of course they are in similar industries, or even if they are not in similar industries, to get knowledge of how do individual line items in the income statement look like. We are going to try and look at what is called as common size income statements. Right now, what do we mean by common size statements? A common size statement is an income statement where each account, each line item of the P&L is expressed as a percentage of the value of sales. Typically, you use net sales for this. This type of financial statement can be used to allow easy analysis between companies or between time periods for the same company, right? So both from the perspective of peer comparison, when we are looking at various companies around us and trying to look at comparison with them, or from the perspective of historical comparison, we can use common size statements, because then this allows us to kind of build each line item in the P&L as a percentage of sales. Right? How do you find anything as a percentage of sales? You take the respective line item and you divide it by the sales number. That's going to be your common size statement. Right? Let's take an example. Let's say there are three companies which are there, and you see the sales for these three companies, you see the numbers for these three companies. They're all doing sales. The first two are doing sales of 1 crore each. The last one is doing sales of somewhere to the tune of 20 lakhs essentially. Right now, it's difficult to compare them directly. Cost of sales for one is lesser, for one is more, so obviously gross profit is higher in the first case. Then there are some selling expenses, but this company also spends a little bit on research and advertising. The first company doesn't do any, the second company doesn't do anything there. The third company spends a lot as compared to their sales on research and advertising and everything. So how do you really go about looking at these numbers? So what do you do when you have to look at common size statements? The basic way of looking at common size statements is you look at this number, cost of sales. So you look at the the 30 lakh number and you divide it by the 1 crore number, which is the sales. So everything has to be divided by the sales number, right? Just divide everything by the sales number. So that's going to give you a percentage value of each one of these as compared to sales. So we divide everything by sales. When you divide everything by sales, you get these numbers. Sales are 100%, obviously, because sales divided by sales is going to be 1. Cost of sales. Now when you compare these companies, you get more relevant data. In the first case, your gross profit margin is 70%. In the second case, it's 25%. In the third case, it's 10%, it's 70%, right? So even though the third company is much smaller in size, you find that their profitability is similar. Their expenses that are given in terms of these three line items are 10%, 20%, 20%. So operating profit at the end of this entire thing is 20% and 20% for both the companies. The second company seems to be making 15% operating profit, but that's because they're not investing anything in research and they're not doing any kind of advertising at all. right? So basically they are less profitable on the gross profit level itself as compared to the first and third company. Now we can compare these two companies and say this one is more profitable, this one is more profitable, this is a red flag here. The companies here, that's research and development is not there, so that's a red flag. But there's a positive that they don't really use any advertising but are still able to sell the same amount. So that's a positive for them. In terms of profitability, you would choose company A and company C, but not choose company B because that's lesser. Selling, general and admin expenses are approximately the same percentage of sales for all these three companies, right? So that's a comparative analysis of these three companies. So the moment you kind of convert it to common size statements, it is easier for us to kind of comprehend and analyze these statements across companies, right? Let's take a simple example and understand this better. Let us look at the following companies, prepare the common size statement for them. So there are two companies, A and B, and we actually have the entire detailed statement available with us. Remember, all we have to do is divide all these by sales to get the common size statement. We can do that, right? So to divide everything by sales. To understand this better, let's go to an Excel file. So those are the numbers that we see. If we have to build common size statements, so what we are going to do is we're going to write about common size statements here, and let's just write A and B here itself, right? So that's what we're going to do. And what do? We have to take sales and we have to divide by sales, and we have to freeze the sales number. Correct? I can convert it to percentages, so that's 100%. All I need to do is drag this down. You've already frozen this, as you would learn in Excel. How do you freeze cell? So you can select this sales number and press F4, and then in each of the formula you will see everything gets divided by the sales number. Correct? I can remove the zeros because that's not really needed for our perspective. Similarly, I will go for company B, take the sales number and divide by the sales number. The denominator is what is frozen. I will put that as 100%, select it downwards, delete the zeros, and now let's compare and make our analysis based on the comparison. So raw material cost higher for company B, marketing cost higher for B, employee cost is also higher for B, correct? So obviously operating profit is higher for A. Then we find that depreciation is about approximately 3%. If we add a few decimal points, we might get more clear ideas. So both depreciation and interest are higher for B, right? So B probably has more debt as well than A on a comparative basis when you compare it to their sales. Tax is higher for A. The tax rate that is happening on an overall sales basis becomes higher for A. That's because obviously tax is calculated on profits. If your profits are higher, the tax number will be here. But in general, the tax number is being calculated here as 30% of your pre-tax profits. So from that perspective, it is similar. Your net profit is higher for A. And so company A is more profitable when you compare it to company B when you look at common size statements. You can now say that raw material cost is higher for company B. You can say that that's higher by about 1.2%. Marketing cost is higher by 1.2%. Employee cost is higher by 1.2% essentially, right? So you could say that these costs are higher and the company is ending up spending more on these areas. And that is why the common size statement is useful when we are comparing two companies with different sizes. We can say that on our analysis, company A looks more profitable, right? All you need to do is take each line item and divide it by the sales number to get a common size statement in percentage terms. You will probably have to practice a little bit more with this with multiple companies and multiple exercises, but that's the broad crux of how do you go about looking at a common size statement, right? Next, we move to a concept called other comprehensive income. Now, that's a slightly tricky concept. Revenues, expenses, gains, and losses that appear in other comprehensive income. These are those gains that have not, when they have not been realized, right? Let's say a company buys a bond or invests in a stock at the price of 100. Now they've not sold the stock. The stock's value has gone to 120. This is unrealized gain that the company has. Something that has been realized, right, when the underlying transaction is completed, such as when an investment is sold. Thus, if your company has invested in bonds and the value of those bonds has changed essentially, right, you recognize the difference as gain or loss in other comprehensive income. Once you sell, then you can realize the gain, or you can then have realized the gain or loss associated with the bonds and shift it from other comprehensive income to a line item higher in the income statement. So usually the way it works is you have an income statement, and under global practices, just below this, you will give what is called as other comprehensive income, right? Now, the treatment of other comprehensive income differs in Indian GAAP and IFRS and all these data points, but typically any unrealized gains or losses that are occurring in the company's normal course of work, they are going to come under other comprehensive income. These are gains that have not been materialized, right? Now, there are broadly four kinds of items that can get classified in other comprehensive income. Unrealized holding gains or losses on investments that are classified as investments held for sale, available for sale. So you're trading in these investments, right? So you're trading in these investments, and if there are unrealized holding gains or losses, they come under a part there. Foreign currency translation gains or losses. So if you're generating $100 of revenue, and that's 6,500 or 6,700 depending on what kind of translation differences are coming in, there could be a gain or loss on account of foreign currency translation. Let's say you buy a bond in the US or you take money from the US. These translation gains or losses are essentially going to be classified here as well. Pension plan gains or losses and pension prior service costs or credits. Now this comes under pension accounting. It is beyond the scope of our discussion at this point of time. Pension is a fairly complicated way of accounting what is due for employees in the future. We're not worried about that accounting at this point of time. All that we need to remember is that if we read other comprehensive income somewhere in the financial statements, that is coming because of some unrealized gains. Note that under Indian GAAP, usually there is no separate representation of OCI. You have to give your net profit statement, and then under that you put in the other comprehensive income if there's anything. Most companies actually report it within the net profit itself. So we don't really see this term very significantly in the context of Indian companies. It is important, however, to know this purely because you will probably come across this across some of the international companies if you're trying to trace them, right? That's the context of other comprehensive income. So not a very important or very extremely relevant topic from our perspective. What is very relevant is the common size statements understanding. Just to quickly reiterate, everything explained as a percentage of sales is what do we mean by common size statements when we are building a common size statement for any kind of company income statement, right? You could also have common size statements in terms of balance sheets and cash flows, but we are worried about income statement at this point of time. That's basically a common size statement. That brings us to an end to this particular section as well. As we end this section, a couple of quick questions. What do we mean by a common size statement? And more importantly, what is the use of a common size statement? Thank you.